2018 has been a challenging year for base metals. The Bloomberg Base Metals Spot Price Commodity Index has shed around 15% from the start of the year to mid-December. So will 2019 prove to be a better year for the complex? Daniel Lacalle is the chief economist at Tressis and is here to discuss. So Daniel, thanks for coming in. Let's start with copper. What are your predictions for next year?
Well, I think that copper is actually one of the base metals in which the supply-demand scenario is better. And you have to take into account the risk of further selling off coming from how much copper-based loans, copper-backed loans, sorry, there are in China. No? But the supply-demand scenario is okay. However, I think that it is likely to be a bumpy 2019. I think that it's very likely that we won't see much of a move up, but at the beginning of the year, it is, in my opinion, very likely that we will see precisely that supply-demand scenario is decent. At the same time, the Chinese economy will present decent levels of growth. Before we start looking at details, all those things are likely to drive copper a little bit higher.
So you're not too worried about the outlook for the Chinese economy?
I'm worried about the outlook of the Chinese economy, but not from the perspective that so many people seem to think about, which is a crash landing. I think it's going to be very much what happens with very directed economies. Even if you look at countries like France, with all the differences, no? And Japan, I think that what we're likely to see is something like that. But because the management of that slowdown is going to come via obviously devaluations and reductions in credit growth, it is very, very difficult that we see massive inflation in the commodity complex that we're talking about right now. Therefore, I think it is likely to be a year in which it recovers a little bit and then it comes down, and we see not more than a big move throughout the entire year, because the second part of the year is the confirmation of the change in the cycle, in the economic cycle that we're living. And we will start to see that industrial production, capital expenditure growth, demand growth, all those will be shed a little bit further, shaved a little bit further. So, you know, a bumpy year, but I think that a lot of the negatives have been priced in the last months, I think.
So what can we learn from the moves in Dr. Copper about the outlook for global growth?
Well, I think that what we're learning is that the outlook for global growth is a lot less exuberant than we were saying, many were saying at the beginning of the year, all this completely crazy concept of synchronized growth and everything is going well and emerging markets rise and oil rises and nothing happens. So I think that what it's telling us is simply that 2018 wasn't an anomaly. What was an anomaly was 2017 and 16, in which we had too high expectations about global growth. And I think that global growth is going to continue to be, you know, moderate, around 3% probably next year, slightly below 3% maybe. But that's nothing bad. There's nothing bad about that. It's bad for inflationary pressures. It's bad if you consider that there is a need for a much higher levels of growth to reduce the debt. But you know, we're close to that sort of, I would say, moderate growth more than a recessionary crisis type of environment, I believe.
Okay, so trade wars, What are you expecting there? If we do get a deal, is that going to catalyse an upside move in the base metals complex? And you know, if we don't get a deal, would it be possible for the base metals to rally, or is that not possible without some kind of a deal?
There will be a deal. This is a negotiation. This is a negotiation, and like all negotiations, the timing of politicians is completely different from the timing of markets and investors. I don't know how long that negotiation is going to take, and there are incentives on both sides to, let's say, take it to the limit. However, there will be a solution. Now, whether that is a catalyst for base metals to go up dramatically, that might be a catalyst into the solution for base metals to recover. But once the trade agreement is there, the reality of the slowdown of both the United States and China, which has nothing to do with trade wars, has everything to do with excess debt, that should make investors take a little bit more caution.
So maybe a little bit of a short-term
So use it, the typical buy the rumor, sell the news, but sell the news because it's not about trade wars. Because what we are seeing is a disinflationary process coming from technology, from excess debt, from too high expectations. All of those things will continue after the agreement.
What about the dollar? Obviously, a lot of base metals priced in dollars on the LME. We've been seeing it push higher in 2018. Do you think it's near to its peak? And if so, what might that mean for the complex?
It is probably close to its peak relative to the other reserve currencies. So relative to the yen, it will continue to be sort of in a balance and relative to the euro. However, relative to and this comes back to the commodity producers and the base metals producers, is that those countries face in 2019 and 2020 a massive debt maturity wall, I call it. No, it's a massive wall of maturities in US dollars. As such, those countries are unlikely to defend their currencies because they need to keep their foreign exchange reserves as much as they can. In that environment, and considering the slowdown, it is very unlikely that they will defend the currencies, so the dollar is likely to continue to be strong, but as a relative. So not because the dollar goes crazily up, but because the rest of the currencies are actually depreciated.
And is the yuan one of those currencies?
And the yuan, obviously, if you look at the slowdown in China, the government can address that slowdown via a domino of bankruptcies in the private sector, which would lead to high unemployment or to an important rise in unemployment, or via a big restructuring of the financial sector that would also dry dramatically credit. None of those things are something that the Chinese government can afford. So if the objective is first and foremost to keep employment at any cost, then it has all the incentives to continue to devalue the yuan, and fundamentally because it's already extremely expensive. It is not a currency that is reflecting its true, in my opinion, purchase parity. No?
So finally, where are the investment opportunities within the base metals complex for 2019?
I think that if you sort of avoid the base metals in which there is this risk of the commodity-backed loans. That is copper, fundamentally, and copper, gold, and oil, slightly iron ore. But there is a good demand-supply balance in zinc. There is an improvement in the supply-demand scenario for aluminum. And there is a good environment in general for those less evident of the base metals bias. So, in my opinion, what I would do is to avoid iron ore and copper, for a long-term perspective. And for long-term thinking, the whole year. Yeah. And look at it from a trading perspective. And in my opinion, the best combination of fundamentals and low financial risk is in zinc.
Okay, Daniel, thanks so much for your time.
Thank you. Always a pleasure.
That was Daniel Lacalle, Chief Economist at Tressis. I'm Victoria Scholar. Thanks for watching IG, and have a lovely Christmas.